Generally, when I'm meeting a founder, I'm often looking at their IQ, EQ, and grit. I had reviewed 824 decks last year, had something which turned into like 210 first conversations with founders, which funneled into about 59 that we took into an actual diligence process and then made 6 investments from there.
I think that's the most detailed, specific funnel that I've ever heard on this podcast. So well done. Welcome back to Funded, where we open up the black box of the fundraise process. I'm Alex Wittenberg, CEO at Air CFO. Lately, I've been obsessed with the topic of vertical AI, so I was really fired up for this conversation. My guest, Nick Tippmann, GP at TipTop Ventures, is an expert in all things vertical AI, or as he refers to it, vertical SaaS 3.0. Nick isn't a career investor. He spent nearly a decade before TipTop as the founding CMO at Greenlight Guru, a category leader in the vertical SaaS 1.0 era. So he's run that vertical SaaS playbook himself, and now he backs founders running it in the AI era at the pre-seed and seed stages. We covered a ton of ground in this episode, but there are 3 main things that you'll want to hear if you're building in vertical SaaS. First, Nick gives a masterclass on what he calls vertical SaaS 3.0, from how he sizes the markets to what clears his benchmarks for earning a check out of 800 plus decks that he reviews every year. Second, we covered pricing. Nick talks about siding between selling seats, selling tokens, selling credits, or selling outcomes. Third, we covered marketing in the age of AI, what's changed, and more importantly, what has not. Finally, there's a thread running underneath this entire conversation. Everyone says that the big AI labs are going to eat everything SaaS and leave nothing for startups. Nick thinks that's exactly backwards, and the way that he laid it out really resonated with me. So whether you're building in vertical AI or the one writing the checks, there's a lot to dive into here. Let's get into it. Let's get into it. Nick Tippmann, thank you so much for joining us today.
Yeah, thanks for having me, Alex. Excited to be here.
Yeah, I'm really excited to dive in on all things vertical SaaS with you, talk about some of the standout companies from your Fund 1, talk about how you're thinking about Fund 2, and overall just give founders a little bit of visibility into the way that a VC makes decisions. And so the goal is to maybe have a founder who's thinking about pitching TipTop, watch this video, listen to this recording, and then come into their conversation with you better prepared to put their best foot forward.
Amazing. Sounds like a plan. Excited for it.
All right.
Fun combo.
Yeah, let's fire it up. So your LinkedIn bio has the phrase vertical AI operator led, which seems like a really tight summary of your thesis as a firm. I'd love to have you start by defining vertical AI for folks who may have heard that term, but find it a little bit opaque. And then I'd also be curious to hear why that operator-led piece is important to your overall thesis.
Yeah, absolutely. So vertical AI definitely has a lot of meetings these days, and I generally use it as somewhat of a catch-all phrase as well. But generally speaking, vertical AI is AI that's specific to a specific industry. Whether that looks in the form of software, infrastructure, or actually an AI model specific for that industry, that is where it's a little debatable, and it is kind of a catch-all phrase in many ways, similar to AI, can mean many things to many people, LLMs, physical AI, etc. But generally speaking, kind of the rounding factor that we look for characteristic is that they're focused on a specific industry and solving a pain point for a specific user or for a specific customer and industry. And then the operator-led aspect of it really goes into the fact that distribution and go-to-market is becoming even more important every day. And so you really want to make sure that you have experienced folks around you that have seen scale and know how to get past that startup phase, that 0 to 1, and continue to scale beyond there. And so if you can surround yourself with folks that have been there, done that, and hopefully learn some of their lessons, but then hopefully also learn from their mistakes and not have to make some of those mistakes, that's where we really see the value in surrounding our founders with experienced operators.
Yeah, that makes a ton of sense. I mean, execution is really one of the only ways that you can kind of differentiate yourself, especially with even like intelligence commoditizing. Um, as an early stage investor, how are you able to select for execution capability before a company has actually kind of made a bunch of strides along their journey, or before they even have much of a team in place at all? Like, what are some of those signals that you look for in your conversations with founders to try to suss that out?
Yeah, absolutely. Generally looking at past behavior and past performance as an indicator of future performance, and so you're really looking into the founder and the founding team's background and experience, and what have they done previously. Have they built a company in the industry that they're going after? Have they raised venture capital previously? Have they had a successful exit? Have they given it a shot and maybe not had a successful exit, or not have the outcome that they were ultimately shooting for? Or if they're earlier in their career or a first-time founder, have they shown signs of excellence before? Were they in a math Olympiad? Were they an elite sport in some sports? Just looking for excellence in their past that shows that maybe you can't lean on specific work experience that's relevant to what they're doing today, but you can lean on behaviors in their past that show and can help you predict how they're going to perform in the future. And so it really depends. It's very context specific on who the founder is, but there are a couple of different profiles that we're looking for. And inside of each of those profiles, there's a couple of different signals that we can look at. But generally speaking, it has a lot to do with what you've done is very predictive of what you're going to do.
Yeah, totally. I was watching an interview with Eric Lyman, the CEO of Ramp, earlier today, and he mentioned that one of the green flags that he looks for when he's interviewing candidates is, were they spending 80 hours a week playing Minecraft when they were in their early teens, which I thought was really funny, but does point towards something pretty core to a person if you see that they have that kind of background. So it's really interesting to think about, like, what are those signals that might not be, Harvard MBA, like the gold-plated resume, that could be predictors of future success for a founder or for an early stage startup employee. What would you say are some of the, I'll give you at max 3 like characteristics that you would point to as being the predictors of successful founders? So beyond like the ability to execute, I'm thinking more about like personality traits or just general disposition. Are there like specific words that kind of come to mind for you?
Yeah, generally when I'm meeting a founder, I'm sure in hiring we've all heard the idea, like early candidates, you're looking for smart, hungry, humble. When you're talking to founders, I'm often looking at their IQ, EQ, and grit. Those are kind of the 3 characteristics. And so they've got to be sharp, they got to be smart, they got to be able to problem solve, figure out what they're doing. But they also need to be able to interact with humans. And it's not intelligence is everything at the end of the day. Building a company is a very human endeavor. Even today, if it may include less humans, it is very human. And building a culture and go back, we've talked about execution a couple of times here already. If you're going to execute, you're going to assemble a large team, lead a large team on a big mission. You need to have high EQ. And then the third one being grit. Like, you understand this. I understand this. Founders understand. It's like building a company is hard. Excuse my language. And so there's going to be a lot of ups and downs. A lot of things that are going to go your way. A lot of things that aren't going to go your way. And so if you don't have that grit and resiliency to continue to push through when times are tough, and also to keep your pedal on the gas when things are good, and understand you got to have perspective in it, and having that grit and resiliency is a big part of it.
Yeah, absolutely. All right, so IQ, EQ, and grit.
Yeah.
In a previous conversation that you had with Joe from Seaplane, you mentioned how the foundational model labs rolling out these armies of forward deployed engineers to implement AI within large companies is proof that intelligence is not all you need to be successful when it comes to taking advantage of AI. So that makes me think a lot about the EQ portion of your founder evaluation. How would you say that building a successful startup in 2026 requires different traits from building a successful startup, say, in the early 2010s?
Ooh, different traits in 2026 versus 2021.
What has become more important today than it was in the pre-AI era from like a people standpoint?
I think really, truly, deeply understanding your customer. The limiting factor previously used to be what you could build and the software. And so if you remove the bottleneck of actually building software and writing code, well, then it's really about having deep understanding and empathy for your customer, their pain points, their hopes, fears, desires, and really understanding what they care about and what's going to move the needle for them. I think that's certainly changed. Another comment that around this that I like to share is like now versus the early 2020s, it's never been easier to start a company. And so even in a lot of these niche markets that maybe like for med spas or auto repair or whatever it is, where there used to only be maybe 1, 2 competitors, maybe a third, that now you're seeing a whole crop of competitors. There might be a half dozen, depending on how big the size of the opportunity or the prizes. There may be a dozen other crack teams going out there going after the same problem. And so with a similar solution, so you've really got to understand why you and why you're going to win. And oftentimes that comes back to the founder's EQ and understanding of the market and their customer.
I like that. And your point about the proliferation of dozens of startups in literally every single niche within the industry really resonates for me. You spent the majority of your career as an operator in the marketing space. And I'm sure you've heard from the front lines that being a marketer in 2026 is as hard or harder than it's ever been. If you were running marketing or you were a founder of an early stage company, how would you go about trying to stand out in the crowd, given that there are probably a dozen other competitors who all have a very similar landing page to what you have?
Totally. I think this goes back to the EQ or the human element. I think it just continues to show the importance of human relationships over time. And so if I was starting out today, I would really look at how do I create those real relationships with my customers and how do I build trust? Because trust is everything at the end of the day. Your marketing campaigns can be copied. Your marketing copy can be copied. What you're putting out there, but what can't be copied is the one-on-one relationships. And so I'd be looking at how can I create relationships with the important customers or prospects in my industry and do that at scale.
What are some examples of building genuine approaches for building genuine relationships at scale?
Yeah, I think what we're doing right here, podcasting, is a great way. Like folks, we're on video. We're in the studio here, broken the third wall there a little bit. But showing people who you are, having real conversations, putting your face out there, putting your thoughts out there. It's hard to come in here, have an hour or two long conversation with someone and really fake what you're about and your ethos and who you are and your brand. And so you can build a lot of trust by being out there. And that's a lot of the reason that I'm doing this. And you see me on podcasts that I'm looking to create a relationship and create trust with founders at scale as well. Some other tactics, I think in the same vein of webinars. So if I think back to Greenlight Guru, our entire marketing strategy could be summarized into building trust. And how we did that was build trust through education. And so another avenue that I would look at how you could build that at scale is how can you educate your prospects? They have problems. It may be related to what your product does. It may not be, But if you teach someone something with no expectation of anything in return and do that genuinely and do that again and again, you're going to build affinity with your prospects and with your customers. And a great avenue or way to do that is through a webinar series. And so those are maybe two offline, or I guess online digital versions, rather than just going to events, dinners, conferences, which I also think are great avenues as well.
Yeah. Piggybacking off of your background as a marketer, how have the conversations that you've had with your customers as a VC, so your founders, how have those shaped the way that you kind of pitch yourself to a founder who you are looking to partner with? And what would you say is kind of the unfair advantage that a founder gains by getting TipTop Ventures on their cap table?
Yeah, absolutely. So when I set out to start TipTop Ventures, I always had it in the back of my head, like if I was going to start a venture fund, I had to be able, being the marketer that I am, I had to confidently be able to say to myself, why would a top founder in the world want to partner with TipTop Ventures? And that was a question that I thought very long and hard about. And when I was putting together the original thesis for TipTop back in 2023 or early 23, ChatGPT had just came out. It became pretty obvious that vertical software, or now what we call vertical AI companies, were going to be some of the best to take advantage of the LLMs. And so I look back, similar to what VCs look for in founder market fit, LPs look for thesis manager fit. And so I thought about what is my onlyness statement? What am I uniquely capable and able to do in the world? And if you look back over the last decade of software in the 2010s, there was only maybe a dozen or so public vertical SaaS companies. A lot of the names like Toast, Shopify, Procore, ServiceTitan, maybe AppFolio, and then there's a longer tail of others. But what I realized is that there's only maybe another 50, 100 people out there in the world that have a decade operating experience running the vertical SaaS playbook at venture-backed growth rates. And I knew that was a unique experience that I knew could provide value to early stage founders. And over the last couple of years, it's been proven and shown that they do respect that and value that as an experience that they want on their cap table. But I also am not so in the belief that my experience alone is the only thing that's going to be able to help. And so I also designed into the fund of building an LP collective of other vertical SaaS founders and execs who have had success as well at many of those places that I just mentioned. And so you get me on your cap table. It's one-on-one. I am a solo GP right now. I'm interacting with all of my founders, but then I also can tap into the network and pull out folks that have built the largest public decacorn vertical SaaS companies that were there from the very early days through ringing the bell and being able to, like, a lot of your job as a VC is also being a connector. And so being able to pull from a pool of folks that have a true, literal vested interest in your success and make those connections is a value add that really resonates with our founders.
Yeah, absolutely. I'd love to come back to the vertical SaaS, vertical AI piece in a minute, but let's talk about your evaluation process at TipTop. So first, just could you give me a high level breakdown of approximately how many deals are you evaluating on a monthly, annual basis, and then how many of those companies end up partnering with TipTop as a portfolio company?
Yeah, for sure. So we're probably legitly reviewing on thesis decks somewhere between 50 and 100 a month. So that's coming out somewhere 600 to 1,200 a year. And knowing you're going to ask a question around this, I went back and looked at some numbers for last year. And I had reviewed 824 decks last year, had something which turned into like 210 first conversations with investor or with founders, which funneled into about 59 that we took into an actual diligence process and then made 6 investments from there.
That is a super helpful breakdown. I think that's the most detailed, specific funnel that I've ever heard on this podcast. So well done.
I appreciate it. Maybe it's a bit of the marketer coming out in me.
Yeah, seriously, the data-driven marketer. So you said 800 that you evaluated?
More or less.
What is the most important signal that you're looking for when you're doing that initial screening? What determines which companies you set that first call with?
Yeah, for sure. So the number one screening criteria is this a thesis fit? And so is it a vertical software, vertical AI company? And then are they at the right stage, which for us is the pre-seed or seed? If those 2 boxes are checked, then I go into a diligence process where we're looking for founder, market, product, or traction. And so the founder can have a couple of different flavors, whether that's deep domain experience, whether it may be some of those more pedigreed, obvious signals that you're chatting about, or it might be something deep in their profile where you learn that they were a math Olympiad, or that they talked about that they played 80 hours of World of Warcraft on LinkedIn somewhere. But generally speaking, you're looking at the founder and the founding team. Then from there, we're looking at the market. From a TipTop perspective, we're looking for a quote unquote large enough market. Generally speaking, the one knock on vertical SaaS or vertical software companies has generally been the limited TAM. Now, the Vivas, Toast, Shopify's of the world have proven that you can continue to grow, add products, and kind of blow through that glass ceiling. But there are markets that are quote unquote too small to potentially look at venture-backed outcomes. And in TipTop's perspective, we're generally underwriting to $1 billion outcome is what a home run in our fund model would look like. And so some of the backwards math that we're looking at of doing that generally means that we're looking at somewhere between a $30 and $50 billion TAM minimum. And this kind of goes into, I know you're going to ask around the progression of vertical software 1.0 to 3.0. Our belief with software plus fintech, which is what vertical software 2.0 brought us, is that these software companies have proven that they can capture about 2 to 5% of the GMV that flows through a TAM. And so just doing some easy backwards napkin math, you take a $50 billion TAM, you take the low end that you can capture 2% of that, that gives you $1 billion potential ARR revenue opportunity in that market. We generally don't want to underwrite for our companies to need to get more than 10 to 20% market share. And so that gives you 100 to 200 million ARR business inside of a $50 billion TAM on the low end. Now you could drop that to 25, 30 billion, push it up to the 4 to 5% on the high end. And that kind of gives you the range and why we're looking for that size market.
I know you talk a lot about total addressable market. We've seen that the most recent wave of AI startups, these supernovas that they've been coined, have grown at rates that were previously unheard of. Do you find that is causing that requires founders to kind of amplify their ambitions when they are coming to you and pitching? Like, have the goalposts truly moved as far as what good enough looks like for an early stage founder pitching a VC?
I think for better or worse, the answer is yes. The goalposts have moved, and yeah, you see the supernovas or the shooting stars that you have out there. And this is one of the things that I think about in VC founder relationships and what's potentially misunderstood. And hopefully maybe this podcast can help clear that up, and others, and talking on this topic and being open about it. But at the end of the day, a VC's job, their mandate is to put a dollar to work in the next best opportunity. And so if they understand that there are shooting stars out there and supernovas that can go 1 to 100 in a year, 1 to 10 in a year, and you're projecting to go from 0 to 1 in a year, like that just isn't good enough anymore. It can't get the VCs excited because your other founder pool of opportunities that are out there are pitching opportunities that can grow at that. It'd be one thing if they were all fairy tales, kind of VCs wishing that we could see those growth rates or those size TAMs, but now we have actual proof points and years of data behind it. And so, for better or worse, the goalposts have gone up.
Yeah. On the topic of TAM, I know you've spoken a little bit about how the total addressable market, and I think this is a function of that shift from vertical SaaS 2.0 to 3.0. The total addressable market has expanded rapidly because now these companies are actually taking on work as opposed to just providing efficiency gains. Could you speak a little bit about the order of magnitude difference from 2.0 to 3.0 companies and what that means for founders who are thinking about going into the vertical SaaS space?
Yeah, absolutely. This is the big trend and the strong why now behind TipTop's thesis, and what has everybody excited around vertical AI is just the order of magnitude expansion of the potential TAM and opportunity. And so if you look at really software SaaS 2.0 and don't even put the vertical on it, you're looking at somewhere between $300 and $400 billion of annual revenues coming through there. If you look at all the services spend in the U.S. And or all of the labor spend, I don't have these numbers off the top of my head. Which one is what? Well, I mean, I can make the guess, but it's somewhere between 4.6 trillion and 13 trillion. I don't know if one is a subset of the other one or if they combined into them. But let's call it at a minimum, you're looking at a $13 billion or 13 trillion, $13 trillion TAM when you look at all of the labor and services spend coming into the economy. If we just do some easy back of the napkin math on that, let's say in a particular opportunity where the work or the task or the majority of the task of a job could be automated by AI, you might be looking at being able to reduce headcount in that specific task or that opportunity, whatever it is, or BPO process that they're running. You could expect maybe you drop the headcount by 70-80%, or the tasks that could be automated by 70 or 80%. Now you're looking, you could maybe software is able to capture 50% of that. And so now you're looking at like 40 to 50% of that $13 trillion opportunity could be converted from either services or human labor salary into some sort of tokens or software or infrastructure spend. And when you are talking about numbers that large, going from 400 billion to 4 trillion and size opportunity, like that's the order of magnitude change that has VCs so excited right now, and why you're able to see these just astronomical growth rates that you're seeing from some of these AI companies.
Yeah. The thing that you said previously that really hit home for me, the opportunity in vertical SaaS, is if you think about the P&L of the customer of a vertical SaaS business, you benchmarked their the startup's opportunity based on like the top line revenue, like what are the GMV, what percentage of the GMV could this company capture. But now vertical AI is actually like unlocking the rest of the P&L and giving a startup the opportunity to save their customers money, but then capture some of that for themselves. So it's not just the top line, but it can help the business's performance in multiple different ways, which is obviously like a pretty massive shift in the dynamics. When you talk about vertical SaaS, vertical AI, this is going to be maybe a jargon-heavy question, but there's this other trend that is percolating out there around AI native services. Do you see any distinction between vertical AI and AI native services, or do AI native services fit in as a subset of vertical AI? Or can you just help me understand, like, where different companies fit in within this kind of taxonomy?
Yeah, absolutely. It's a great question. I think about it a lot, and yes, I would say vertical services as software companies are a subset of vertical AI. When I say vertical AI,
This is a good segue to talk about, to come back to the three eras of vertical SaaS. So could you just talk a little bit about the transition from vertical SaaS 2.0 to 3.0, which is vertical AI?
yeah, for sure. So we'll start all the way back at 1.0, which is the pure software companies. These are companies like Autodesk, Viva, that were selling software to specific industries. The 2.0 change brought the fintech opportunity into the mix, and that's what you see with Toast and restaurants, Shopify and e-commerce, Service Titan and the trades. And now with 3.0, we still have software, we still have fintech, but now we have AI and the opportunity to not just make work more efficient, but actually do the work as well. Once you get into vertical software 3.0 or vertical AI, there are a couple of different themes and theses inside of that as well. And that's where this idea of services as software would fit as well. And so when I'm diligencing an opportunity, I'm trying to see which one of these themes under vertical AI does the company fit. And two of the dominant themes right now are building a system of work, which is essentially the older school or legacy system of record taxonomy with a system of action that sits on top of it. You bundle all of that together, and we'll call that a system of work to try to define some of these jargons that you talked about setting this up. And then over on the other side, you have the services as software, very similar, but the difference becomes that the vendor, the software company, builds the system of work, and then rather than selling it to the customer, they actually keep it for their own internal use, and they just sell the outcome directly to the customer. And they're more often than not, if you are able to if that model does work in your industry, then you're able to capture more of that margin and more of that value that you're providing to your customer, rather than just selling them a seat. You could sell them a lead or whatever the outcome is at the end of the day. I think of them as two of the same part. And so if you are, and this is for the founders out there, if you're thinking about building a vertical AI company, almost all of them should start with thinking about who are the system of records, and are there already system of actions, or is there an opportunity to build a system of action to build this system of work? And then the question becomes, do you sell that system of work to the end user directly or to the customer directly, or do you keep it in-house and then sell them the outcome? But the stages and steps that you take at the earliest days of planning are very similar, because in both cases, you're building a system of work. It's just your delivery mechanism that changes.
Yeah, that is very well said. So in this battle for vertical AI as it's unfolding, you have the incumbent systems of record, which are trying to build or upgrade those into becoming systems of work. And then you have these two different flavors of disruptors who are trying to build a system of work from the ground up, and then either deploy it for themselves internally in the form of a service or sell it directly to customers. Given that this is kind of like the battlefield, this is where the battle lines are being drawn, and we can rule out the incumbents unless you think that there's anything to say about like the role that incumbents play in specific markets. Which of those two approaches do you think, like, what are the relative pros and cons of those like opposed approaches? And how do you kind of evaluate whether a company is taking the right approach or maybe going down the suboptimal path?
Yeah, it's a really, really good question. I think the first one that comes to mind we look at is who are your end users, and what does the makeup of your end market actually, how does it segment? What does it actually look like? What percentages are SMBs? What percentages do the top end enterprise own? Do they own 80% of the revenue, but are only 5% of the number of customers? And how easy or difficult is it to get your customers to potentially adopt the software? And then also thinking about, are you able to actually deliver an outcome where with you delivering that outcome, the results of that can continue to learn in your system and feed your own model to continue to get better over time? That would be another way that we look at the difference. And then also the margin profile of your customers. Like it goes back to, what does the makeup of the market look like, but what's going to be your cap to be able to reach them? And so, yeah, I think it's often a function of your end market, and if you are able to architect a value prop where you actually can deliver an outcome, and this may change over time. The example that I like to use here, when looking at, we'll call it a market or an industry's maturity or readiness to accept outcomes. I'll go to my background and go to market. Like the ultimate would be an AI system of work platform that helps you close a deal. Like at the end of the day, it prospects the lead, it sets the meeting, it runs the sales process, it does the demo, it goes through security, procurement, and then it gives you like that. That's a lot to ask of AI these days. In particular, you start getting up in mid-market enterprise contracts, it's just not feasible today. So how can I break down this process from prospecting all the way to close deal and potentially look at more micro outcomes that happen inside of that? And so maybe I'm not selling you today a closed deal, but instead I'm selling you a warm lead, or I'm selling you a booked meeting, or I'm selling you a demo, and that we're breaking down these micro outcomes, and you can have more confidence that you can get the result that you're looking for at the micro that allows you to maybe eventually build to the bigger outcome. And so that's another dynamic when we're looking at what's going to be the best model. You may start by selling software today and end up selling more of an outcome over time. But yeah, that'll depend on the market and the market's maturity.
Yeah. The key piece to me of what you just said is that like all paths are ultimately converging on delivering an outcome for the end customer, which also ties back to your thesis around empathy for that customer and understanding like what problems they need solved, like that being one of the most important factors separating success from failure in the future. So that all tied together really well. I know this is also very related to another topic that you've been spending a lot of time thinking about, which is pricing. How do you think about the ways that today's AI startups are pricing? There's a kind of a spectrum of different types of options, from marking up tokens to converting to credits to ultimately like selling the outcome directly. How should a founder who is just getting off the ground think about which of those pricing strategies is right for them? And does the right answer actually shift across the startup journey? Like, do they need to start in a specific place, but then start in a more general place, maybe selling the tokens, and then get more specific over time?
Yeah, I think it's a really good and interesting question. I don't know that I have a definitive answer on where they should start or how they go about it, or which of those models ultimately is going to be better. When I talk about pricing, and I'm advising founders on pricing, having played a big role in it for many, many years at Greenlight, I think a lot of the principles and foundations of a top-notch pricing strategy have stayed more similar than maybe they have different, in the sense that generally in a best practice pricing model, you want to have 2 or 3 different axes that you're able to move against, and whether that's tokens, whether that's credits, whether that's seats, there needs to be some sort of variable component. But it often ends up looking like some sort of good, better, best packaging as one that often is a good fit for the size of the company or the segment that you're going after. Some sort of different value in there, and then you want to have some sort of value metric that's tied to it, and maybe some additional functionality. And that's where you kind of see this enterprise pricing, if you will. But maybe it's a certain package of number of token credits that you're getting per month, and then over a certain limit, then it's variable above that. But you want to have a couple of these different levers that you can pull, so that when you're negotiating with customers, you have places that you can give, and you have places that you know you're going to stand. And that also, going back to the comment around having empathy for your customers and why that's so important. You also, and to your comment or question, does it change over time? You also really want to make sure you're meeting your customers where you are. And so a piece of feedback that I'm hearing a lot from our founders that are in this very forward-thinking Silicon Valley type mindset of everything's going to outcomes. Well, when you're talking to the HVAC customer or the liquor store down the street or the med spa or whatever it is, oftentimes a lot of them are used to buying seats today. And so if selling and pricing your software with seats today is the wedge that you need to get your foot into the door, and it's going to make the sale easier, and your unit economics still work and everything else still works with their model, like I say, go for it. There's no reason to rip it down if it's working today, but know that over time, with where things are headed, you likely will need to keep an eye on that, and maybe you need to shift it over time. So yeah, I go back to the best practice principles of pricing, which I don't think have changed, but the specifics that you put in there, like you mentioned, are maybe what's changing today, and it might shift over time.
Yeah, I think it can be very insightful to, in times when things are changing so rapidly, to come back to what things are not changing. Are there other aspects of how you evaluate companies that you think have not changed as a result of all of the developments that we've seen in AI?
It's a really, really great point and really well said. I think when I look back and what I say through all of this era of AI and all the changes that have happened and are coming, like human psychology does not change. Like we are big monkeys at the end of the day, and it took millions of years, millennia to kind of get us to where we are today, and we have all sorts of biases and ways in which we think irrationally. And with AI, I don't think any of that's changing. And so it just really goes back to one of the first questions or the thesis around understanding your customers, the importance of humans, and having high IQ or EQ, excuse me.
Mm-hmm. Yeah, that's a really great point. And given that venture investing is really a business that centers around like human to human collaboration, how do you evaluate that part of a potential relationship with a founder that you're considering going into business with? Like, I'd imagine that this happens continuously across your evaluation process. But what are some of the, not necessarily formal frameworks, but how do you think about whether on a human level, you and the person sitting across the table from you are going to make a good match as a team partnering up over the next decade plus?
Well, I think a lot of it really comes back to how the co-founders are going to relate to each other over the next years and decade plus. It's important for the VC and the founder to get along, but I don't feel like I need to be best friends with every founder that we invest in. Yeah. People have different personalities, different styles. And if I only wrapped it around who I thought I'm going to quote unquote get along with or like to have a beer with, that's probably eliminating a large portion and population of potential successful founders out there. And so I'm cautious to put too much bias on how well I think we're going to work together. That being said, then with the co-founder, like it's very important to me how the two co-founders interact. If you have two co-founders on the same call, are they talking over each other? Are they cutting each other off? Are they finishing each other's sentences, or do they trade off? And then it goes back to what you've done, very predictive of what you're going to do in the future. And so this is where reference checks becomes a big part of the game, and making sure you do enough of them to have a wide enough swath on a person that you're getting a good view of who they are. And oftentimes that you'll get the best insights from the off list references. And so pinging your network, finding out who used to work with them at XYZ company, checking out maybe they gave you two of their bosses, but they've had 5 roles. Maybe you reach out to one of the other 2 and get their feedback. And so yeah, I don't know that there's a formal framework that I'm putting together from an EQ perspective that we're out there checking boxes. But it is a very human process and evaluation when it's very much in many ways. And I hate to use the analogy, but when you're making a hire in many ways, now as I maybe place a little less emphasis on the getting along because you're not having to be there every day. But
have there been situations where an interaction that you've observed between co-founders has kind of tipped you off to a potential investment maybe not being the right opportunity for you?
Totally, for sure. And the signals are a lot of what I share, like talking over each other, like this idea of co-CEO. This isn't the example to use, but almost presenting as co-CEOs, not understanding the roles and responsibilities, both kind of sitting puffing up their chest versus a very fluid relationship with we'll just use a standard CEO, CTO relationship where one's owning the front end, the business, the customer, and one's owning the technical aspects of it. And they know their roles, they know their lane. There's probably a Venn diagram of their skills where they help each other as well. But it's like, these are the areas that I'm owning and I trust no matter what that they're doing. And there's the other areas. And so I would say another way that often comes out and shows are just founders that haven't worked together very long, and particularly more experienced founders that maybe have had a go or two, or maybe particularly if they've had a success go or two. If they had their success without having to realize in some ways of working very closely with people, that comes out on the call, and it generally is stepping on people's toes.
Yeah, I would imagine that's a sign that the co-founders just like haven't had the hard, frank conversations, or maybe are avoiding them, which is a negative signal because you really get thrown into the pressure cooker once you take venture funding.
Totally. And one last piece to add on to that one as well, more on the first-time founders also, because you also see a lot in first-time founders and how they interact with each other. They may have known each other for 5-10 years. They may have even grown up together, but they don't have 10-15 years of professional experience where they've had to learn some of these more EQ things. And so in some ways, it may not be a reflection on their relationship of them talking over each other or stepping on each other, but more of a read on the maturity of the founders themselves.
Mm-hmm. Yeah, absolutely. We're bopping all over the place here, but let's talk a little bit more about team building at the early stages. So you have the privilege of getting to see these early stage companies that are probably super cracked on AI, and building a team in 2026 is a very different journey than building a team would have been pre-AI. What are you seeing tangibly shifting in the way that teams form and sort of evolve now that we have intelligence on demand filling roles within early stage org charts?
Yeah, for sure. So very tangibly, I think the importance and the profile of your initial marketing leader and growth leader is shifting. The importance of being AI fluent and understanding systems, processes, being very much data driven. I almost look at the growth leader of the future um, often or having the skill set of an ops leader, whether it's rev ops, marketing ops, sales ops, but understanding what the progression and flow through a process is, the data that matters in that process and through that flow, and then how to read, measure the data and course correct based on the opportunities that you're seeing. I think that can be vastly more important these days than maybe 5 or 10 years ago, where you'd want to hire a product marketer initially that's going to help you make sure you get your messaging and your positioning correct. I'm seeing a lot more of that role and responsibility shifting on to the founders themselves and going back to really needing to understand your customer and having the empathy for them and understanding their hopes, fears, and desires yourself. Um,
Hmm.
I think another one on the technical front. This obviously definitely isn't my area of expertise, but um, you are starting to see folks that maybe have had great careers that haven't picked up and become AI native or AI fluent over the last couple of years. Um, get laps ran around them versus folks that may have a tenth of the experience that they have. And I think the frameworks and the principles needed to develop in the age of AI are maybe easier to come by than the deeply technical skill set that maybe an enterprise CTO would need to have and 10 years ago. I'm trying to think of some more tangible examples of like what's super excited too. Like I really love when founders prioritize design and user experience early. And this is a first principles take as well that just goes back to if everything can be copied so quickly, then what's going to make you stand out and change? Well, and if LLMs can build designs and what's the word I'm looking for? A brand framework or UX framework, design system, excuse me, like out of the box, like that's going to be really important. But understanding the user experience of how someone is going to be using your product and deeply understanding that and using that. Um, I guess this is where, as I'm speaking in real life, this idea that designers, developers, and product managers are converging into one. That again, this isn't where I have spent the last 15 years, but I can totally see how that's happening. And so, whether I call this a UX researcher or a product manager, of having someone that's really going to understand, get in there and understand and have that empathy with your customer, I think is massively important and can be as important, if not more, than your technical lead being truly elite in the early days.
Yeah, that's really interesting. Um, what you described with the marketer, the shift of the marketing role, it almost reminds me of like it feels like the important skill there is systems architecture, which is sort of like the role that a marketing executive at a bigger company would have played back in the day. But then an early stage marketing person also needs the ability to like roll up their sleeves and actually do the building themselves, because it's not just, tell a human what to do and they figure it out. Like it really requires getting down into the weeds and like fine tuning every step along the way. So, I mean, it can unlock a lot of new capabilities, but maybe that's like an explanation for why we haven't seen a proliferation of examples of like marketing departments running fully autonomously, is because we really are looking for a unicorn, like someone who can kind of do both ends of the spectrum there.
Yeah, it's a unicorn is a great description of the person that you're looking for in the earliest stages there, because they do have to have a ton of skill sets. And when I would hire marketers, I always use the framework of like a T shape of the very broad at the top. They go deep in different areas. And yeah, maybe another way to explain it is I think the shape of the T, uh, where they're spiking is changing at the earliest stage, where it had been on messaging and positioning. Now it's maybe on systems thinking and architecture. Um, but I hear you in the sense that you are also needing someone that can do both sides of it. Not only do they need to be able to architect the system themselves, but they need to actually be able to get their hands dirty and build it themselves as well. I'm sure you've heard the term popular, like the go-to-market engineer. And I think that is in this same line of thinking as well, that marketers should think much more systemically or in systems, and they need to think a lot more like engineers, and they should engineer their go-to-market engine. And so the role is becoming more technical and more data-driven without a doubt. But you still got to have the other, like the top of the T doesn't go away. And so you still have to have those other skill sets.
Yeah, and it's arguably making the non-LLMable things even more important. So as much as you need that engineering mindset, you also need the artist mindset too.
Yep. Well said.
All right, we're coming up on time here. Just to bring us home, what's a trend or a generally accepted state of the world in tech today that everyone seems to be buying, but you're selling?
I'll go back to maybe a topic that we talked about at the beginning, the belief that the foundational labs and the LLMs are just going to eat everything and there's going to be nothing left for anybody else. We've seen this movie before with the hyperscalers, and the big objection used to be, well, what if Google builds this? Well, the answer is they can't be everything to everyone. And like I said in the other podcast that you referenced earlier, the fact that the large labs are all funding and founding these armies of consultants and these consulting services companies to go in actually shows you that intelligence alone isn't going to be enough. And back to the human element as well, is what they're learning is that changing people, and like what changes, what doesn't change, back to the idea that people don't change, like that's the hardest part, the change management of these businesses. And so you're still going to need humans. You're still going to need customization. You're still going to need deep specificity in specific areas and specific departments. And so I would say the idea that the labs are going to eat everything and it's going to leave nothing or no room for companies at the application layer, I would say is pretty much absolutely backwards.
Yeah, you can look at multiple cycles that we've taken like around this question over the last 30 years of technology. An analyst that I really appreciate named Benedict Evans talks a lot about broadband, compares what happened in the broadband era to what's happening today in AI. And he brought up that AOL at one point tried to build their own bank because, you know, they were building the rails. And so they were going to go into fintech. Maybe they were trying to do SaaS, vertical SaaS 2.0 before it really was ready for prime time. But yeah, I think we're going to see something similar happen in the AI space. The only thing that gives me a little bit of pause there is that what we've been seeing coming out of the foundational model labs from a product velocity standpoint is pretty much unprecedented as well. And so it's like, I imagine that they probably have dozens and dozens of products that could potentially be launched like tomorrow and compete in just about any vertical. So some of the constraints that have held back previous waves of platform companies, I guess the jury's still out on how much those apply going forward. But overall, I definitely agree with your take. I think that there is so much value in going deep with a specific customer to understand their problems. And that's something that the large language model labs just aren't going to put in the legwork to do, because it's not automatable necessarily.
Yeah. Really, really well said.
Thank you. We talked a lot about, your perspective on investing. Is there anything else that you would offer up to, say, a first-time founder who is looking to take investment from TipTop or a similar VC? Like, what's a piece of advice that you think is underappreciated, or is like the number one thing that more founders should be doing to increase their chances of success?
Yeah. I'll go back to really, really deeply thinking about and treating your go-to-market engine like a product that it is. I feel like I've been shouting this for the rooftop for some time now. And what's the old meme of like first-time founders worry about product, second-time founders worry about distribution. Like that's been out there forever. But I will say being in the market today, particularly for first-time founders, like pitch your unique go-to-market strategy and why you're going to be uniquely able to execute it just as hard as your product. Because if you go back to what we talked about, easier to build, higher competition than ever, which lends towards VCs wanting to invest in more experienced founders and domain experts. And so if you're a first-time founder out there, how can you stand out or show yourself that you are different than some of the other early stage founders? Well, start thinking like that second time founder, and don't just think like them. Show up to the pitch that you've done your work and you do have your unique insight. Like literally unique insight is a great way to phrase it. I would say even just, we expect you to have that on your product as to why you're building. I think the expectation should be just as high as to what's your unique insight on the go-to-market realm as well.
I like that a lot. Well, Nick, thank you so much for sitting down with me today. I really enjoyed this conversation. Where can people learn a little bit more about you and TipTop VC if they're interested in following up?
Yeah, really, really appreciate it, Alex. Very much enjoyed the conversation as well. It's been a ton of fun. Yeah, you can find us on LinkedIn, Nick Tippmann or TipTop VC. That's where I'm most active. Also active over on X. And then I would tell the founders to go check out our website as well.
All right. Fantastic. Well, really excited to share this with the startup community. I think we got some really great insights in here, and looking forward to following along with your journey.
Thank you, Alex. I really appreciate it.